I want you to just listen to my voice for a moment. Forget everything happening on the screen. If you can, close your eyes, because what I'm about to explain isn't loud or dramatic, but it will decide whether you lose money or come out ahead when the next market crash hits. No hype, no predictions, just the reality most people never understand. For the next couple of minutes, just stay with me, because the difference isn't created during the crash, it's created before it even begins. Have you ever wondered why most people lose money in the market, even after investing 4 years? It's not bad luck, it's a loop. They follow the same habits, react the same way, and when the market starts falling, they do exactly what everyone else does: they panic. That's the trap, a silent psychological pattern where the majority reacts emotionally, while a small group stays calm, prepared, and positioned. And if you're still here right now, listening, that already puts you in a different category, because most people don't slow down enough to understand what's really happening. They wait until it's too late. Here's the truth: market crashes don't destroy wealth, they expose behavior. And in the next few minutes, I'm going to break down exactly what separates the people who lose from the ones who quietly take advantage of it. So don't rush this, don't skip ahead, just stay here, because when things start falling, you won't rise to the moment, you'll fall to your level of preparation. Most people are going to lose a staggering amount of money in the next market crash. And the craziest part, they won't even know why it's happening. They'll panic. They'll feel that gut-wrenching pain in their chest as they watch their life savings evaporate on their phone screens, and they will sell everything at the absolute bottom. They will effectively destroy decades of hard work, sweat, and sacrifice in a single afternoon. But a small, elite group of people, the ones who understand exactly what I'm about to show you, are going to walk out the other side with more wealth than they had before the crash even started. Today, I'm going to show you how to set up your compounding strategy so that a market crash doesn't destroy you. It actually makes you richer. Everyone talks about investing for the long term and staying the course, but nobody actually breaks down the cold, hard mechanics of what you should be doing right now, today, so that when the market drops 30%, 40%, or even 50%, you aren't the one panic selling at the worst possible moment. Instead, you'll be the one buying while everyone else is running for the exits. I've been studying market history for a long time, and I'm not here to scare you, but I believe you deserve the truth, not some watered-down version of it. Market crashes are not rare catastrophes. They are a completely normal and healthy part of the financial cycle. If you don't know how to handle them, you're going to lose money you simply didn't have to lose. The first thing you have to understand is that compounding is fragile. It's one of the most powerful forces in personal finance, the process where your money earns returns, and then those returns earn more returns. But most people don't understand how it interacts with a crash. Let's look at the real math. If you invest $10,000 and earn 10% for 2 years, you have $12,100. This is compounding doing its thing. But if in year 3 the market drops 40%, you aren't back at your original $10,000. You are at $7,260. To get back to where you were, to that $12,100 mark, you don't need a 40% gain. You need a 67% gain just to break even. This is called the asymmetry of losses. A loss requires a much larger gain to recover. This is why people who panic sell during a crash often never fully recover their wealth. They lock in the loss at the bottom and miss the massive rebound that follows. They stay in the trench of disappointment forever because they broke the chain of compounding. The data is incredibly clear on this. According to a study by Fidelity, if you invested $10,000 in an S&P 500 index fund from 1980 to 2022, you'd have over $1.08 million today. But if you missed just the 5 best trading days in those 42 years, just 5 days out of more than 10,000, your total wealth would shrink to only $671,000. Think about that. 5 days of being out of the market cost you nearly $400,000. If you missed the best 50 days, you'd have only $76,000 left. You took all the same risks, you sat through the same stress, but you made 14 times less money just by being out of the market at the wrong moment. Compounding is a long-term game of patience, and the goal is to never interrupt it. You need to realize that market downturns are completely normal. A market correction, which is a 10% drop from a recent high, happens every 1.2 years on average. These are healthy. They are the market hitting the reset button. A bear market, a 20% drop, happens every 4 to 5 years and lasts about 10 months on average, and a full collapse of 30% or more is rare, but it is a mathematical certainty over a 30-year career. The question isn't if it will happen. The question is if you'll be ready to profit from it. There are 3 specific actions you must take today to survive the coming storm. First, you must protect the foundation. You need a financial cushion, an emergency fund of 3 to 6 months of your total living expenses sitting in a high-yield savings account. I don't care if it's only earning 4% or 5%. That money isn't there to make you rich. It's there to keep you from becoming poor. During a crash, economic chaos follows. People lose their jobs. Medical emergencies occur. And expenses don't stop just because the stock market is down. If you don't have this cash reserve, you will be forced to sell your investments at the absolute bottom just to pay your rent or buy groceries. That isn't bad luck. That's bad planning. Your emergency fund is the insurance policy for your compounding. It allows you to sleep at night while the world is burning, knowing that your lifestyle is secure and your investments can stay exactly where they are. Second, you must set up dollar cost averaging and automate it completely. Instead of trying to time the market, which is impossible, you invest a fixed amount of money every single month, regardless of what the market is doing. When the market is at an all-time high, your money buys fewer shares because they are expensive. But when the market crashes 40%, your same monthly investment suddenly buys double the amount of shares. Crashes are discount events, not disasters. But here is the secret. You have to automate it. When the news is screaming that the Great Depression is back and your portfolio is deep in the red, your biological brain will scream at you to stop. It will tell you to save your cash. Automation removes the human element. It removes the emotional part of your brain from the equation. It forces you to buy at the exact moment when the greatest wealth is generated, at the very bottom. Third, you must get your portfolio properly diversified before the crash happens. Diversification does not mean owning 10 different tech stocks. It means spreading your capital across different asset classes, different sectors, and different geographies. This allows you to rebalance. Rebalancing means selling a bit of what's done well to buy more of what's dropped. This is forced buying low and selling high, the opposite of what most people do instinctively. Over time, rebalancing significantly improves returns because it keeps your compounding working across your whole portfolio, not just the parts that happen to survive. Diversification is actually harder to maintain during good times because when one sector is crushing it, it feels wrong to move money out of it. But that concentration is exactly what leaves people exposed when the crash comes. The real problem isn't the strategy, it's the psychology. When your portfolio drops, your brain triggers loss aversion. Research shows the pain of losing money is twice as powerful as the pleasure of gaining it. Losing $1,000 feels twice as bad as gaining $1,000 feels good. This is biology, and it is lethal to long-term investing. The solution is to make decisions before the fear kicks in. Write down your investment plan today. State exactly what you will do if the market drops 20%, 30%, or 50%. When the crash comes and the fear kicks in, do not look at your portfolio. Do not watch the news. Pull out that document and follow the orders you gave yourself when you were thinking clearly. History shows that the best trading days often happen during or immediately after a crash. 7 of the 10 best days in S&P 500 history occurred during the 2008 financial crisis. If you sold to protect yourself, you missed the rebound. In 2020, the market dropped 34% in 5 weeks, but fully recovered in 5 months. Those who stayed in and those who kept buying through the dip made extraordinary returns over the next 2 years. Market crashes are the greatest wealth transfer events in human history. They take money from the impatient and hand it to the disciplined. You have the plan, you have the math, and now you have the execution. Stop being a spectator. Take control of your numbers and start building your empire today. I am David, and at Sleek Capital, we only speak the truth. Now, go build.